Do you want to build wealth through the US stock market but don't know where to start? In today's video, I'll break down the basics of stock market investing for beginners, covering what stocks are, how to pick the right ones, and the simple strategies you can use to start investing today. Stick around until the end, because I'll reveal a beginner-friendly tip that could help you maximize your returns and avoid rookie mistakes. Hey everyone, welcome back to Finance, your guide to smart money decisions. If you're new here, be sure to hit that subscribe button for regular updates on personal finance and investing. Today, we're diving into the stock market, which is one of the most powerful tools for building long-term wealth. But I get it, starting can feel overwhelming with so many terms and choices. That's why I've created this step-by-step guide to help you feel confident as a beginner in the US stock market. Let's get into it. Section 1. What is the stock market? So what exactly is the stock market? Think of it as a marketplace where companies sell pieces of ownership, called stocks or shares, to investors. When you buy a stock, you're essentially buying a tiny slice of that company. As the company grows and becomes more profitable, the value of your share increases, which can lead to capital gains. Plus, many companies pay dividends, extra income, just for holding their stock. But remember, not every company succeeds, so picking the right stocks is crucial. We'll get into stock picking strategies shortly, but first, let's talk about how the US stock market works. Section 2. How the US stock market works. In the US, there are two primary stock exchanges: the New York Stock Exchange, NYSE, and NASDAQ. These are where the trading happens, with millions of transactions taking place daily. Most stocks you'll hear about are traded on one of these two exchanges. But how do you actually make money? It's simple. You can profit in two ways. 1. Capital gains. This happens when you buy a stock at a low price and sell it at a higher price. 2. Dividends. Some companies pay out a portion of their earnings to shareholders, providing a steady income stream even if the stock price isn't rising fast. Section 3. Why invest in the stock market? Now, you might be wondering, why should I invest in the stock market when there are so many other investment options? Well, over the long term, stocks have historically provided higher returns than almost any other asset class. On average, the US stock market has returned around 7 to 10% per year after inflation. That's significantly better than savings accounts, bonds, or real estate in many cases. The key is long-term growth. Even though the market has its ups and downs, staying invested over many years can help smooth out the risks and lead to substantial wealth accumulation. Section 4. How to start investing in the stock market. Alright, so how do you actually start investing? It's easier than ever with today's technology. Here are the basic steps. 1. Choose a brokerage account. A brokerage account is where you'll buy, sell, and hold your stocks. Some of the most popular options for beginners include Robinhood, Fidelity, TD Ameritrade, and Charles Schwab. These platforms make it simple to open an account online, and many of them offer commission-free trading. 2. Decide how much to invest. As a beginner, don't feel pressured to invest a lot right away. A good rule of thumb is to start with an amount you're comfortable losing, as there's always some risk. It's also smart to avoid putting all your money in the stock market at once. Spread it out over time. A method known as dollar cost averaging, which helps reduce the impact of market volatility. 3. Pick your first stocks or funds. Here's where a lot of beginners get stuck. What stocks should you buy? The simplest approach is to start with index funds, or ETFs, exchange-traded funds. These are collections of many stocks bundled together, which means you're automatically diversified. Instead of trying to pick individual winners, you can own a little piece of the entire market through funds like the SP 500 ETF. This way, your risk is spread across hundreds of companies. If you prefer individual stocks, consider blue-chip companies like Apple, Microsoft, or Coca-Cola. These are large, established firms with strong track records and are less risky than smaller, newer companies. Section 5. Key investment strategies for beginners. Let's talk strategy. Here are a few beginner-friendly methods for getting started. 1. Buy and hold. This is the simplest and most proven strategy. Buy quality stocks or index funds and hold them for the long term. Market timing is nearly impossible to get right consistently, so rather than trying to buy low and sell high, focus on buying and holding over decades. Over time, the market's upward trend will work in your favor. 2. Diversification. Never put all your eggs in one basket. Diversifying your portfolio across different sectors and types of assets helps reduce risk. For instance, instead of investing all your money in tech stocks, you could spread it out across healthcare, consumer goods, and financial stocks. Or better yet, invest in ETFs that automatically diversify for you. 3. Reinvest dividends. If you're investing in dividend-paying stocks or funds, reinvesting those dividends is a great way to compound your growth. Most brokerage platforms offer automatic dividend reinvestment, so you don't have to lift a finger. Section 6. Avoiding common mistakes. Now, let's cover some mistakes that beginners often make so you can avoid them. Chasing hot stocks. Don't jump into stocks just because they're trending. Often, by the time a stock is hot, most of the gains have already been made, and you're buying at a peak. Stick to solid, long-term investments. Panic selling. Markets fluctuate. There will be days, weeks, or even months when the market drops. Don't let fear drive your decisions. Remember, the stock market is a long-term game, and temporary dips are normal. Overtrading. Frequent buying and selling can rack up fees and reduce your overall returns. It's usually better to make thoughtful, long-term investments and stick with them. Section 7. The power of compound interest. One of the most powerful concepts in investing is compound interest. The earlier you start, the more time your money has to grow exponentially. For example, if you invest $5,000 at a 7% annual return in 30 years, you could have over $38,000. Thanks to compounding. That's why it's so important to start investing as soon as possible, even if you're only putting in small amounts at first. Section 8. Bonus tip. Automate your investments. Here's the bonus tip I promised. Automate your investments to make the process even easier. Most brokerage accounts allow you to set up automatic deposits. So you can consistently invest a fixed amount each month without even thinking about it. This set it and forget it strategy ensures you're always putting money to work, no matter what the market is doing. So, there you have it, your beginner's guide to investing in the US stock market. Remember, investing doesn't have to be complicated. Start small, stay consistent, and let time do the heavy lifting. If you found this video helpful, please give it a thumbs up and subscribe for more personal finance and investing tips. Let me know in the comments if you have any questions or topics you want me to cover in future videos. Thanks for watching and happy investing.